I would never sell or purchase an IUL unless I understood the 5 major numbers that affect how it's structured. In today's video, you are going to get a masterclass on how to properly design and structure an IUL to meet yours or your client's goals. Now, IULs are just financial products that are simple, but they're built on the chassis of life insurance, which means they can be complex in design because there's 3 different uses for them that you can design them for adults. First, it could just be simply supplemental tax-free income in retirement. Second, it could be for immediate access to cash or what we call infinite banking. Third, it could just simply be for permanent life insurance and living benefits. Depending on the age of your client, each one of those strategies could incur a completely different funding schedule, or essentially how money needs to be funneled into the IUL to meet these different goals. And there are 5 major numbers that you need to constantly be looking at to ensure that this IUL is properly structured. And if you stick with me through this video, I'm going to actually share with you how to properly structure the IUL to meet each one of these goals. First, we need to understand the 5 major numbers. Let's take a look at what's called the minimum no lapse premium. This is the minimum amount of premium or money the client needs to deposit into this account on a monthly or an annual basis to guarantee that the IUL stays in force for at least 20 years or longer. Next, you're going to see the target premium. This is the number that your agent is actually going to get paid a percentage of for their commission for helping a client out with that policy. Now, it's also the annual premium number that the agent needs to make sure the client is depositing into that IUL in their first 12 months, because if the insurance company doesn't receive that target premium in full from the client in the first 12 months of that policy being open and active, most insurance companies, not all, but most, will give that agent a partial chargeback on their commission. Now, this number also affects the clients too. I always tell my clients that the target premium is the number you always want to make sure you are overfunding if your goal is to grow cash value, because every dollar you're contributing in excess of that is really ensuring that your cash value account is actually going to grow. If you're contributing under the target premium, well, you're going to see very slow growth on your cash value, and that's not most people's goals with an IUL. So I tell them, think of the target as your minimum. Even though there is a true minimum, you want to look at the target premium like it's your minimum, because you always want to be overfunding that every single year. Then we've got what's called the guideline annual premium, or the GAP, which is just simply the maximum amount of money your client or yourself can contribute into that policy every single year for the life of the IUL. Next up, we have the 7-pay premium, which is just simply the maximum amount of money your client can contribute into the IUL in the first maybe 3 to 5 years of it being opened. And that's pretty much dependent on their age for how many years they can do that. So I always just explain to the client that you get a little bit of extra wiggle room in the beginning of the policy, and then after that, in year 7, it's going to get reduced down to the guideline annual premium for the most you can contribute per year in all years of the policy being open. And then we also have what's called the single pay premium, which is really the most amount of money that can be put in total into the IUL in the first 3 to 5 years. Even though they have that 7-pay number, you cannot put in more than the 7-pay number per year, and that total cannot exceed what's called the single pay premium. It's also easily defined as the amount of money that once the IUL carrier receives that, you can pretty much assume that that IUL will be paid up and will last them for life. Now, it's also important to know what is controlling all of these numbers. These numbers are controlled by the death benefit, or what we call the face amount, the amount of life insurance that the client is purchasing. If the client purchases more life insurance, all of these numbers are actually going to increase. If the client purchases less life insurance, all of these numbers are going to decrease. So if you're trying to control the number, we're going to change the amount of life insurance that the client is getting. Next, you need to understand the difference between what is called a level or an increasing death benefit. With a level death benefit, that means that the cash value that you're growing in your IUL does not get added to your death benefit when you die. As opposed to an increasing death benefit, your cash value that you're accruing does get added to the death benefit when you die, and it pays out to your beneficiaries all tax-free. Now, I know you might be watching this thinking, well, an increasing death benefit sounds better. Most cases, yes, but there actually are times where you wouldn't use an increasing death benefit, and we're going to explain that as we dive into these examples. Now that we understand the 5 major numbers and what controls them, let's go back and revisit the 3 different ways you can design an IUL for adults. First, we've got that supplemental tax-free income in retirement. For this type of client, you will want to be looking at what's called an accumulation IUL. And I always start off by asking my client, what is the most amount of money you could see yourself saving into that IUL per year over the next 5 years? Whatever number they tell you, that is the number you are going to try to get the guideline annual premium, the GAP, to reach. But you also need to be mindful of the amount of money that they can currently save per month into that product. What they can currently save, the current premium, times 10 should just about equal the target premium inside that IUL. That is going to allow that client some wiggle room to be able to contribute more money in later years. For example, let's take a look at a 35-year-old healthy male that doesn't smoke, whose goal is to save $1,000 a month within 5 years from now, but he can currently save $500 a month. Now, if the client is 55 years old or younger, I typically would recommend go with an increasing death benefit because most of the time they've got some time for that money to grow and they're going to want that cash value added to that death benefit when they die. And the easiest way to figure this out in your illustration software is to put in $1,000 a month as your monthly premium and then solve for what is called minimum non-MEC. That means the software is going to tell you the least amount of life insurance required for that premium going in so you can structure this correctly. Now, the issue with that is sometimes the software is going to spit out some random number like $258,317 for life insurance. Do me a favor. Don't be a rookie and don't sell that or don't purchase that. Make sure their life insurance is rounded up or down by increments of 25 or 50,000. That's just going to make your death benefit nice and clean. For this scenario, I would round down to a $250,000 death benefit. And the first thing you're going to notice is the GAP on this policy is actually less than $1,000 a month, which is $12,000 a year. But that's okay because the client will not be fully funding this policy at $1,000 a month from the very beginning. And what's going to happen is he's going to get what's called carryover. So from the years in the beginning where he didn't fully fund it, he's going to have excess carryover from those years that he'll be able to contribute into in years later on. So with an IUL, it's like if you don't use the full amount of money that you can contribute in a given year, you don't lose it. It carries over to the next year and the next year, so you can always kind of back pay that IUL. You'll also notice here that the target premium is super low, which means the client is doing a great job overfunding their IUL. This is properly structured. The second way you can design an IUL for an adult is for immediate access to cash, or what we call infinite banking. Now, in this scenario, I will typically go with an accumulation IUL as well. And usually your client is going to be fully funding that IUL immediately, either an annual premium or a monthly premium, because their goal is to take out cash relatively pretty quickly. Typically, you want them to fund it at what's called the 7-pay premium, because again, that's the most amount of money the client can contribute in the first 3 to 5 years. But here's the catch. Let's just say, for example, you have a client that tells you they want to put in $100,000 one time into the IUL and then never again. Unfortunately, that's really not going to make a lot of sense. And the reason is because you'd have to get this massive death benefit to be able to hold that $100,000 that's going in 1 year, and then not to contribute anything in years after. The client would be paying all of this money on a yearly basis to own this IUL when they don't need that big of a policy. What would actually be better would be for them to slice and dice that $100,000 up into 4 years and put in $25,000 a year over 4 years. That would allow you to reduce the death benefit, get a lower life insurance amount, which would reduce the cost and ultimately help their cash grow quicker. Depending on your client's goals, you could go with a level or an increasing death benefit for this option. If the client is older, I would probably be looking at a level death benefit. If they're younger, I would probably still be looking at an increasing death benefit because they still have time for that money to grow and most likely want that cash value added to the death benefit when they die. So if we look at that same example from earlier with a 35-year-old healthy male that doesn't smoke, this time with the goal to save $100,000 broken up over 4 years, which is essentially $25,000 a year, you can plug those numbers into your illustration software, and you can also still solve for what's called minimum non-MEC, right, which will give you the least amount of life insurance required to be able to do this. In this scenario, this illustration software spit out $475,000 as the death benefit. But if you understand IULs, typically most insurance carriers will give you some kind of a price break every time you reach $250,000 inside the death benefit. So I would actually recommend rounding this death benefit up to $500,000 because it's going to be a little bit of a discount to purchase that versus the $475,000. You'll also notice that we are overfunding the guideline annual premium, but we are underfunding the 7-pay. And the reason is because we also have to be mindful of that single pay premium, right? We don't want to over contribute, because if we put in over the single pay premium, well, now you've created what is called a modified endowment contract, or what we call a MEC, which means any interest you earn inside of that IUL moving forward is taxable. So you want to make sure you don't ever overfund it. In fact, most insurance carriers won't even really allow you to, but you want to be mindful of that when you're structuring it. So from what I can see here, this IUL appears to be in good shape. And the third way you can design your IUL for an adult would be for permanent life insurance and living benefits. Now, these requests typically come from our more mature in age clients, potentially 55 and up, where they are really just looking to get permanent life insurance with living benefits and they don't care so much about the cash value. So I would recommend maybe look at a protection IUL because they tend to have a lower cost of insurance over time than an accumulation IUL, but the cash value isn't going to grow as quickly as it would in an accumulation IUL, so just keep that in mind. In this scenario, we were looking to try to get the client as much life insurance as possible for the smallest amount of money on a monthly basis. However, you still always want to fund the IUL at least at target premium annually. So this might be a scenario where the monthly premium times 12 could equal the target premium. This is how we ensure that that policy will actually stay in force and active for them long term. So if we take a look at a different example this time of a male that is 55 years old, let's say he's just in decent health, he's in standard health, he is a non-smoker, and his goal is to get $250,000 in permanent life insurance. You can simply plug those numbers into your illustration software and solve for target premium, and the software will actually tell you what the target premium is or what the client would need to fund per month or per year to keep this policy in force and active. As you can see in this situation, the client would need to be funding about $350 a month to maintain this policy in all years. This policy would be properly structured if this fits their budget. So as you can see, once you understand the 5 major numbers of an IUL and how funding it at different increments affects the overall use, it's really not that complicated once you have this stuff mastered. Now you might be left there thinking, well, I still have questions. I want to learn a little bit more. All you have to do is click the links that I have here. They'll tell you more about how IULs work. And make sure to subscribe if you want to continue to educate yourself today so you can elevate your finances tomorrow.